In a recent debate, the CNBC Investment Committee discussed where the tech sector could be headed next and whether the recent weakness is creating opportunities or warning signs for investors. One of the biggest takeaways from the discussion was their view that the market is finally questioning AI demand. I'll play the CNBC Investment Committee discussion uninterrupted first, then I'll break down the key points, share my own reaction and analysis, and reveal 2 oversold growth stocks that could be worth buying right now. Let's hear what the Investment Committee had to say.
It's too soon to say, oh, that's it. We saw the top of tech, never going to be as good again. People have made that call over the last 3 years on multiple occasions, and then pie right in the face. So Jonathan's a technician. I don't think a technician wants to say a rocky 30-day period is like the end of what's been a 36-month bull market. And I don't want to say that either. However, Mag 7 are now, as a group, negative on the year. We had blow-off tops in Korean stocks, memory stocks. You see the semis bouncing 3% today. Not a ton of conviction, not a lot of volume behind these moves. The software rally that added fuel to the fire, well, that's unwound very quickly. At their peak a few days ago, the software names got to within 11% of their year highs. Now they're backed into a 23% drawdown. A lot of broken hopes and dreams in that space. So I'm looking at the action in Oracle. I'm looking at some of these unwinds continuing to unwind far below where I thought the unwinds would go. And I'm basically sitting here saying, why tech right now? It's too messy, technically. There's so many other things that are working. I want to spotlight. We talked about Casey's. This is both a Porterhouse constituent and in the best stocks in the market. We've been talking about it all year. It's literally pizza in Nebraska. I don't even know what the story is here beyond just higher gas prices, more revenue. Look what the market did to this stock yesterday. Went up 15% on earnings. It is the best performing name this week in the S&P 500. There are a lot of Casey's general stores in the tape. We don't need to just be minutely focused on the microns every single day. I think there are a lot of ways. Starbucks is up 7% over the last week. Darden's up 8%. Best Buy, believe it or not, up 7%. Kenvue up 7%. There are places to make money. There are winners in every sector in the market. Insight, a biotech, up 7% over the last week. So that's what I'm focused on, Judge. I'm not as focused on how long will this tech unwind go for. It hasn't gotten me out of bed yet. They're not down enough for me to say, that's it, we're good. And I don't think things are as dire as the bears do.
I think Jenny, B of A largely agrees with, the views of Josh. Too early to buy beaten down tech, they say. It's time for value. As he points out a number of stocks, that's really the epicenter of the debate right now. Buy the dip in tech or buy other things that are available at pretty reasonable prices that have all but been forgotten in this huge run up.
Right, and I think there's been a lot of movement into that already. So for me, I look at the portfolio and I have stocks that are up like 60%, 80% on the year. And they're things that we don't talk about, like Ryman Hospitality Properties and Lamar Advertising, which does billboards, or in our growth strategy, Materion, which is a materials company, or Albany International, which is like carbon weave fibers. So there's a lot out there. So I worry a little bit, Scott, that the positioning, the move into value has already started to happen, and that some of that bloom is off the rose already. I think there's more to go. But when I think, I totally agree with Josh, and I think too, when we think about Mag 7 being down, I think of it more as flat. And I think that is really healthy. There is, to your point exactly, there's so much messiness going on right now. They're going from cash flow producers to cash flow consumers. The whole world's changing. So I actually feel really good about them just being flat. And I look at this as maybe not an either or, but fine, let them consolidate, let them grow into those multiples, which they're doing. I think it's incredibly healthy. And if you happen to have new money, maybe just start to continue to broaden that out, even though it's already happened. But I don't think you're going to get, I don't know. I look at it and I'm like, shoot, some things are up so much. I would have rather entered them 6 months ago.
Mega cap's not flat. I mean, you look at the percentage that they're off their 52-week high. Yeah. I'm talking about the Mag 7. Okay. Microsoft's 27% off its 52-week
within the Mag 7.
high.
You're right.
Meta's down 27% off of its 52-week high. Amazon's down 12. Nvidia's down. They're all down considerably off of their 52-week highs. It shows you the the selling that's taken place in the very top heaviest part of the market. I don't know how you, Rob, feel about opportunities to buy some of the dips at this point. I think we're all kind of waiting for the dip buyers to show their hand, and there's not a lot of conviction yet, as we said off the top of the broadcast.
I view that as a really healthy thing, that there's not a lot of conviction yet. But again, I would fall into the camp that many of these have not fallen enough. And keep in mind that we own a lot of these. We are talking to clients about building positions into our growth portfolios, into our dividend portfolios at right times. And sometimes that takes a 5% reset, which the only area we got that was in tech, right? And so we took advantage of that. We'll talk about that later in the show. But it was much more surgical than typically. There's no doubt that this has been an earnings-driven market year to date. And what's done well should have done well, because that's where the implications of earnings growth have been the highest. What's interesting, and what they were talking about, is the re-rating that we see. 40% of the stocks in the S&P are down for the year. It's just a really interesting dichotomy. So I do view it as a little healthy that this is happening.
Why don't you think that these names have fallen enough? If you point to the fact that it's been an earnings-driven move to begin with, the reason why the Microns of the world and the Marvells of the world ran up the way they did straight up into the right is because their earnings presented a new paradigm for those stocks.
Correct.
They forced people to understand that they were underestimating the earnings momentum that they appeared to have. So if they've pulled back, what makes you believe that they haven't pulled back far enough?
Because the tokenomics discussion has entered the chat. That's the real answer.
Here is the thing that I think. When you price a terminal value and you price it off an exceedingly high earnings period, which some of those earnings were driven by sales, right? There was still healthy organic earnings growth, but there was still profits being brought in by sales of privates. And I think sometimes we can pull forward enthusiasm into price, if that makes sense.
It does. Well, is that what we did with the Microns of the world?
We did briefly. Now we're going to re-rate and re-underwrite for what I believe is a more sustainable earnings growth trajectory. And I think it's going to be a little more broad-based. And I think you can still be constructive on equities, but let's be honest, we're entering a seasonally weak period. You have geopolitical tensions that are pressing on rates. You're in a quieter earnings period, and so usually you have something come along to save the day in the interim. You have midterm elections coming up, and you have a couple big IPOs that are coming, and the reality of it is supply is coming onto the market. And so this is just digestion. It's not negativity. And I want to react really to Oracle, for example, announcing a spend.
Yeah.
If you run a private company, and this is why I love investing in private companies, you don't need to manage quarter to quarter. So when you see a long-term opportunity that is going to change the ROE characteristics forward of your business, as we do all the time at New Edge, we will make that investment even if there's a quarterly impact. A company like Oracle is going to come out and say, we are committed to this spend because we know this is an arms race and we are going to win. They actually had good numbers. I don't own Oracle, but I'm using them as an example. And the market punishes that. Guess what? That gives you an opportunity to get in there and think about that.
You could say it's rightful punishment. I mean, by these equity offerings, it's dilutive, obviously. People had already been concerned with Oracle's debt raise. Now it's an equity offering. The point being, their spending machine is ramping up, not down.
May I? The fundamental thing that's changed in the last 2 weeks is this discussion about the price of compute.
That's right.
The value of these workloads. And we're now going to, I think, the second half story. You'll see this desk, closing bell, it'll be filled with people saying what I'm about to tell you right now. What's going to happen here is we're going to start to delineate between premium usage of compute versus cheap, dirty usage of compute that should not require the same pricing on compute and the same amount, the same volume of compute. So me looking up a recipe for fettuccine bolognese should not be taking place in the same part of the data center using the same chips as NASA trying to calculate the trajectory of a satellite launch. But that is literally what the AI build-out has started as. It's just this,
but it's starting to bifurcate.
Correct.
You're looking at
right, that's exactly right. And now what we're going to start to see is haves and have-nots. We're going to see Adam Smith economics start to weigh on all of this activity. Companies starting to get rational about, wait. Why are we underwriting all of this AI usage that's just blanket, yeah, sure, put whatever you want in the query and we'll consider all that compute the same. And so what you're seeing in the stock prices, which is, we're not a tech show, we're a stock show. What you're seeing in the stock prices is we think, are we really going to have memory demand on the scale that we thought we would? Are we really going to have chip usage in the same way that we have? And all of a sudden, as rational economics take hold, you're going to start to see a rethink in all of this earnings growth and whether or not we think it's
The panel starts by focusing on the weakness we've been seeing in technology. The Nasdaq had been under pressure, semiconductor stocks had been selling off for days, and investors were clearly becoming nervous after what had been an incredibly powerful multi-year run in AI-related names. The key point raised early in the conversation is that this may not be a complete change in market leadership. Instead, it could simply be a positioning unwind. That's an important distinction. A positioning unwind means investors became too crowded in the same trades, particularly AI, semiconductors, cloud computing, and the Magnificent Seven stocks. When everybody owns the same names and sentiment gets too optimistic, even good companies can experience sharp pullbacks because investors start taking profits. A regime change, on the other hand, would imply something much more serious. It would mean the entire investment thesis behind those sectors is breaking down. The committee seemed largely unwilling to declare that we're seeing a regime change. Josh Brown made a point that I think investors should remember. Over the last 3 years, countless people have repeatedly called the top in technology. Each time those predictions ended up looking premature. The AI trade, cloud trade, and mega-cap technology trade have consistently surprised skeptics. That doesn't mean the stocks can't fall further. It simply means investors should be careful about assuming a few rough weeks automatically signal the end of a long-term bull market. At the same time, Josh wasn't exactly bullish on jumping into technology with both feet either. What stood out to me was his observation that many of these stocks are behaving poorly from a technical perspective. Software names that had rallied aggressively suddenly gave back large portions of those gains. Semiconductor stocks were bouncing, but the bounce lacked conviction. There wasn't strong volume supporting the moves. In markets, conviction matters. A stock can rally 3% in a day, but if nobody is really buying aggressively behind that move, it often tells you the selling pressure hasn't fully exhausted itself. Personally, I think that's a very reasonable concern. One of the biggest mistakes investors make is assuming every dip deserves to be bought immediately. Sometimes stocks need time to reset, sometimes valuations need time to catch up with reality, sometimes enthusiasm gets ahead of fundamentals. And that brings us to one of the most important themes from this interview. The panel repeatedly emphasized that there are many opportunities outside of technology. For years, investors have become conditioned to focus almost exclusively on AI stocks, chip stocks, and mega-cap technology companies. But Josh pointed out that plenty of stocks have been quietly delivering incredible returns without making headlines every day. He mentioned companies like Casey's General Stores, Starbucks, Darden Restaurants, Best Buy, biotech names, and a variety of consumer and industrial companies that have been performing exceptionally well. This is where I think the conversation gets especially valuable. When investors become obsessed with a single theme, they often overlook opportunities elsewhere. The market is much larger than 7 technology companies. There are hundreds of businesses benefiting from different economic trends, different consumer behaviors, and different earnings cycles. One of the biggest lessons from this discussion is that leadership in the market can broaden. You don't necessarily need Nvidia, Micron, or other AI winners to rise every single day for the overall market to continue moving higher. Jenny Harrington expanded on that idea by explaining that some of her biggest winners this year weren't even names that investors talk about regularly. She highlighted companies in real estate, advertising, industrial materials, and specialty manufacturing. Her concern was actually the opposite of what many investors might expect. She worries that the rotation into value stocks and non-technology sectors may already be well underway. In other words, investors who are just now discovering these opportunities may not be getting in at the beginning of the move. They could be arriving after much of the easy money has already been made. That's a really important point because market rotations don't happen overnight. Often, by the time financial television starts talking about a new trend every day, smart money has already been positioning itself for months. Another fascinating part of the discussion centered on the Magnificent Seven stocks. The host pointed out that many of these companies have fallen significantly from their highs. Microsoft, Meta, Amazon, Nvidia, and others are all well below previous peaks. Yet Jenny viewed that weakness as healthy. Her argument was that these companies needed time to consolidate. They needed time to grow into their valuations. I actually agree with that assessment. One of the problems with explosive rallies is that stock prices sometimes move much faster than earnings. Even if a company continues performing well, the stock can still stagnate while earnings catch up to justify the valuation. That's not necessarily bearish. In many cases, it's exactly what a healthy bull market needs. Then the conversation shifted toward earnings. Rob Sechin argued that this year's market has largely been driven by earnings growth, and that's difficult to argue against. Many of the biggest winners generated strong gains because their earnings outlook improved dramatically. However, he also introduced a concept that I think investors need to understand very carefully. He suggested that enthusiasm may have pulled future expectations forward. In simple terms, investors may have become too optimistic about how quickly certain AI-related companies could grow. That's something we see repeatedly throughout market history. When a revolutionary technology emerges, investors often assume the future will arrive immediately. The technology eventually changes the world, but the stock prices frequently move ahead of the actual business results. As expectations become extremely high, it becomes harder and harder for companies to surprise investors. That's why even good earnings reports sometimes result in falling stock prices. The expectations become almost impossible to exceed. The discussion then moved into what I consider the most important part of the entire interview, the economics of AI. Josh Brown argued that the market is beginning to ask serious questions about the value of compute power. For the last several years, the AI build-out has largely operated under the assumption that more compute is always better. More chips, more data centers, more memory, more infrastructure. But investors are starting to ask a more nuanced question. How much of that compute demand is actually valuable? Josh used a great example. Should a simple consumer query searching for a dinner recipe consume the same level of expensive AI infrastructure as a scientific research project, military simulation, or aerospace calculation? Probably not, and that's where things get interesting. The market may be entering a phase where AI demand becomes segmented. Premium workloads that generate substantial business value could justify premium pricing. Lower value tasks may not. If that happens, the economics of AI could become much more sophisticated than investors originally assumed. Personally, I think this is one of the biggest investment questions of the next several years. The first phase of the AI boom was all about building infrastructure. The second phase may be about monetization. Investors are no longer asking whether AI is real. They already know it is. Now they're asking who actually makes money from it, how much money they make, and whether current valuations accurately reflect those future profits. That's a much harder question. The panel also discussed Oracle and the market's reaction to its spending plans. Some investors viewed Oracle's investments negatively because they require additional capital and could dilute shareholders. Others argued that management is simply making long-term decisions to remain competitive in what has become an AI arms race. I tend to lean toward the latter view. History shows that transformative opportunities often require massive upfront investments. Companies that hesitate can fall behind. Companies willing to invest aggressively sometimes suffer short-term pain but ultimately emerge stronger. Of course, not every investment works out, which is why markets debate these decisions so intensely. Overall, my biggest takeaway from this interview is that the committee is not sounding the alarm on technology, but they're also not blindly buying every dip. They're acknowledging that AI remains a powerful long-term theme. They're acknowledging that many technology companies still have enormous earnings potential. But they're also recognizing that expectations became extremely elevated and that the market is now reassessing those assumptions. At the same time, they're reminding investors that opportunities exist well beyond the AI trade. That's probably the most practical lesson from the entire discussion. Markets rarely move in a straight line. Leadership rotates, winners change, new opportunities emerge. And while everyone is focused on whether AI stocks have fallen enough, some of the best performing investments may already be quietly delivering gains in sectors that most investors aren't even paying attention to. That's why staying diversified, staying patient, and staying focused on fundamentals remains just as important today as it was before the AI boom began. The technology story is far from over, but the market is clearly entering a phase where investors are demanding more evidence, more discipline, and more proof that all of this AI spending will ultimately translate into sustainable profits. Now let's dive in and break down two oversold growth tech stocks that could have the potential to reward patient investors over the next decade. Let's start with the first stock, Lemonade, ticker symbol LMND. Here's a question every investor should ask themselves. What happens when one of the oldest industries in the world gets completely reinvented by artificial intelligence? Because that's exactly what Lemonade is trying to do. Insurance isn't a flashy business. Most people don't spend their free time thinking about insurance companies. But insurance is one of the largest industries on the planet. People need it to protect their homes, their cars, their families, their pets, and their financial futures. The problem is that the insurance experience has barely changed for decades. Customers often deal with paperwork, long waiting periods, confusing pricing structures, and frustrating claims processes. Lemonade believes artificial intelligence can solve many of those problems, and if they're right, the company could become one of the biggest disruptors in the entire insurance industry. What makes Lemonade different is that it wasn't built as an insurance company trying to add AI later. It was built as an AI company from the very beginning. Today, Lemonade offers renters insurance, homeowners insurance, life insurance, pet insurance, and car insurance. But what truly separates the company is how it delivers those products. When a potential customer visits Lemonade's website, they interact with an AI chatbot called Maya. Instead of spending time talking to an agent, filling out endless forms, or waiting for someone to call them back, Maya can generate an insurance quote in less than 90 seconds. Think about how powerful that is. In a world where consumers expect instant gratification, reducing friction can be a massive competitive advantage. But the innovation doesn't stop there. For existing customers, Lemonade uses another AI assistant that can process and pay some claims in just a few seconds. That's a dramatic difference compared to traditional insurance companies, where claims can sometimes involve multiple phone calls, paperwork requests, reviews, investigations, and lengthy waiting periods before a customer receives payment. If you've ever had to file an insurance claim, you already understand why this matters. Customers don't just want insurance, they want convenience, they want speed, they want simplicity, and Lemonade is attempting to deliver all three. What's particularly exciting is that this strategy appears to be working. At the end of the first quarter of 2026, Lemonade reported a record 3.1 million policyholders. That represented year-over-year growth of 23%. Now, some investors might hear that number and move on, but let's think about what it actually means. Insurance is not a social media app where people casually sign up and leave a week later. Insurance customers are making real financial commitments. Every new policyholder represents trust. Every new policyholder represents recurring revenue, and every new policyholder increases the size and strength of Lemonade's ecosystem. Even more impressive is what happened to the company's in-force premium, often referred to as IFP. In-force premium represents the total value of all active insurance policies. This figure climbed to $1.3 billion during the quarter, increasing 32% year over year. And here's the detail that really caught my attention. This was the 10th consecutive quarter in which Lemonade's IFP growth rate accelerated. That's not just growth, that's accelerating growth. When a business is getting larger while simultaneously growing faster, investors should pay attention. Because that's often where some of the biggest winners in the stock market come from. The next piece of the story might be even more important. Let's talk about efficiency. One of the biggest challenges facing most businesses is that growth often requires hiring more people. Need more revenue? Hire more employees. Need more customers? Hire more employees. Need more support? Hire more employees. The problem is that payroll costs can eventually eat into profits. Lemonade is pursuing a very different path. Since the end of 2022, the company has actually reduced its workforce by 6%. At the same time, it managed to double its in-force premium. Read that again. The workforce got smaller. The business got significantly larger. That's exactly what investors want to see from a technology-driven company. The result is that Lemonade now generates approximately $1 million in in-force premium per employee. That puts the company on par with some of the largest insurance businesses in the industry despite being a fraction of their size. This is one of the strongest arguments in favor of the stock. Artificial intelligence isn't just helping Lemonade attract customers, it's helping the company operate more efficiently, and efficiency can become a powerful competitive advantage over time. Imagine two companies competing for the same customer. One relies heavily on human labor, the other automates significant portions of its business. Which company is likely to scale faster? Which company is likely to generate higher margins? Which company is likely to create more value for shareholders? The answer seems obvious, and that's why many investors remain excited about Lemonade's future despite the stock's volatility. Now let's talk about the opportunity ahead. The insurance market is enormous. We're talking about trillions of dollars in premiums globally. Lemonade doesn't need to dominate the industry to become a much larger company. It only needs to continue taking market share. And based on the current trajectory, management appears confident that the runway remains substantial. In fact, Lemonade has outlined a long-term goal of growing its in-force premium to an astonishing $10 billion. To appreciate how ambitious that target is, remember that the company currently sits at approximately $1.3 billion in in-force premium. Management is essentially targeting growth of around 670% over the next decade or so. If they come anywhere close to achieving that objective, the financial results could be extraordinary. Of course, investors shouldn't simply accept management targets at face value. Every executive team has ambitious goals. The real question is whether the company is showing evidence that those goals are achievable. And so far, Lemonade's customer growth, premium growth, and improving efficiency suggest that management is executing effectively. Now let's turn to valuation, because this is where the story becomes especially interesting. Many growth stocks have experienced significant pullbacks as investors became more selective and less willing to pay extreme valuations. Lemonade was no exception. The stock remains well below previous highs. For some investors, that's a warning sign. For others, it's an opportunity. Wall Street currently expects Lemonade to generate approximately $1.6 billion in revenue by 2027. That's more than double the company's 2025 revenue of $738 million. Think about that growth profile. The business is expected to more than double revenue in a relatively short period of time. Yet despite that outlook, the stock currently trades at a forward price-to-sales ratio of roughly 2.5. For a company with Lemonade's growth potential, many investors would argue that's surprisingly reasonable. And here's where the math gets really compelling. Lemonade's current price-to-sales ratio sits around 5.4, which is roughly in line with its 3-year average valuation. If the company reaches the revenue expectations analysts currently forecast, the stock would need to rise approximately 116% by the end of next year just to maintain that same valuation multiple. That's not a prediction, it's simply a way of illustrating how much revenue growth is expected relative to where the stock trades today. The market doesn't always reward companies immediately. Sometimes stocks stay cheap longer than investors expect. But eventually, if the business continues delivering strong results, valuation and fundamentals often move closer together. That's why oversold growth stocks can be so interesting. When sentiment becomes negative while the business continues improving, opportunities can emerge. Now, let's be balanced. There are risks. Lemonade is still a developing company. The insurance industry remains highly competitive. Claims expenses can fluctuate. Economic conditions can impact customer behavior. And investor enthusiasm for growth stocks can change quickly. Those risks are real. But investing is always about weighing risks against potential rewards. And when I look at Lemonade, I see a company attempting to modernize a massive industry through artificial intelligence. I see a company growing customers, growing premiums, improving efficiency, and pursuing a market opportunity measured in trillions of dollars. Most importantly, I see a company that still appears to be in the early innings of its growth story. Will Lemonade become the dominant digital insurance platform of the future? Nobody knows. But if management continues executing at the current pace, and if artificial intelligence continues improving productivity throughout the organization, the upside could be significant. That's why Lemonade remains one of the most intriguing oversold growth stocks investors should be watching right now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second stock, Meta Platforms, ticker symbol META. If Lemonade represents a company trying to disrupt a massive industry, Meta represents something completely different. Meta is already one of the most dominant businesses on Earth. The challenge for Meta isn't becoming bigger. The challenge is figuring out how to keep growing after already reaching billions of people. And that's exactly why this opportunity is so interesting. Most investors think the growth story is over once a company becomes massive. History has shown that's not always true. Sometimes the biggest winners are the companies that figure out how to monetize their existing advantages more effectively. That's exactly what Meta is doing right now through artificial intelligence. Let's start with the scale of this business. Meta owns Facebook, Instagram, and WhatsApp. Combined, these platforms are visited by more than 3.5 billion people every single day. Just stop and think about that for a moment. Almost half of the world's population interacts with Meta's ecosystem on a daily basis. Very few businesses in history have ever achieved that level of reach. And when you own platforms that attract billions of users every day, you possess something incredibly valuable: attention. In today's economy, attention is one of the most valuable assets in the world. The longer people stay on a platform, the more advertisements they see. The more advertisements they see, the more money the platform generates. That's why Meta's next phase of growth isn't necessarily about adding hundreds of millions of new users. It's about increasing engagement among the users it already has. And this is where artificial intelligence enters the picture. Many investors think AI is only about chatbots and image generators. But for Meta, AI serves a very different purpose. Its job is to understand users better than ever before. Every time you interact with content, watch a video, click a post, share a picture, or spend extra time reading something, Meta's systems learn more about your interests. Artificial intelligence then uses that information to recommend additional content that keeps you engaged. The better those recommendations become, the longer people stay on the platform. The longer people stay, the more valuable Meta becomes. This is one of the reasons why AI could become one of the most profitable investments Meta has ever made. Chief Executive Officer Mark Zuckerberg believes Meta's latest AI models are becoming dramatically more sophisticated. According to Zuckerberg, these systems are developing a deeper understanding of every photo, every video, and every user's interests and goals. That opens the door to significantly more personalized recommendations, and the implications are enormous. Imagine opening an app that seems to understand exactly what information you need at any given moment. Not just entertainment, not just social interactions, but useful information that can help improve your life. Whether someone wants to learn how to cook, improve their health, build a business, or better manage their finances, Meta believes AI will eventually deliver increasingly customized experiences tailored to each individual user. If that vision becomes reality, engagement could increase substantially. And increased engagement usually translates into increased revenue. We're already beginning to see evidence that Meta's AI investments are working. During the first quarter of 2026, Meta generated an incredible $56.3 billion in revenue. That's a staggering number by itself, but the growth rate is what really stands out. Revenue increased 33% year over year. Even more impressive, that growth accelerated from 24% during the previous quarter. Think about how unusual that is. Most large companies experience slower growth as they become larger. Meta is doing the opposite, it's accelerating. When a company generating tens of billions of dollars every quarter starts growing faster, investors should pay attention, because that usually indicates something important is happening beneath the surface. In Meta's case, artificial intelligence appears to be driving stronger user engagement, better content recommendations, and improved advertising performance. The market often rewards businesses that can successfully combine massive scale with accelerating growth. Meta is attempting to do exactly that. Now let's talk about what makes this stock particularly interesting today: valuation. One of the biggest mistakes investors make is assuming that great companies always trade at expensive prices. That's not true. Sometimes even world-class businesses become temporarily undervalued because investors focus on short-term concerns. Right now, Meta trades at a price-to-earnings ratio of approximately 21.3. Meanwhile, the Nasdaq 100 trades at a price-to-earnings ratio of roughly 35.3. That gap is difficult to ignore. Meta is one of the most profitable technology companies in the world. It serves billions of users. It generates tens of billions of dollars in quarterly revenue. Its growth rate recently accelerated, yet the stock trades at a valuation significantly below the broader technology benchmark. That's one reason many investors view Meta as potentially undervalued. Of course, there's a reason the market is being cautious, and it's important to understand that concern. Meta is spending enormous amounts of money on artificial intelligence infrastructure. The company is expected to spend as much as $145 billion on AI data centers during 2026. That's an extraordinary amount of capital. Management clearly believes AI will play a central role in the company's future. They're not making small bets. they're making massive investments. The short-term downside is obvious. Those investments will pressure earnings over the next several years because the infrastructure must be depreciated for accounting purposes. Some investors worry that Meta may be spending too aggressively. Others believe these investments will create an even wider competitive advantage. Personally, I think this is one of the most important debates surrounding the stock, because if management is right, these investments could strengthen Meta's ecosystem for years. If management is wrong, shareholders could face years of lower profitability without corresponding benefits. That's why investors should continue monitoring spending trends over the coming quarters. Any indication that spending is becoming more disciplined while growth remains strong could be viewed positively by the market. But here's what makes Meta particularly compelling. Unlike many companies pursuing AI, Meta already has one thing most businesses desperately want: a proven business model. Meta doesn't need AI to create a business. Meta already has a business that generates enormous amounts of cash. AI simply has the potential to make that business even more valuable. That's a very different risk profile compared to companies that are still trying to figure out how to monetize their products. Meta already knows how to make money. The question is, how much more money artificial intelligence can help it generate, and given the scale of its user base, even small improvements can have massive financial consequences. That's the power of scale. A 1% improvement for a small company may not matter much. A 1% improvement for a platform serving more than 3.5 billion daily users can create billions of dollars in value. This is why I believe many investors underestimate Meta's long-term opportunity. They focus on the size of the company and assume growth must eventually slow down. But artificial intelligence may be creating an entirely new growth engine. Instead of simply connecting people, Meta is evolving into a platform that understands people better than ever before. That transformation could drive engagement, advertising revenue, and profitability for many years to come. When you combine that opportunity with the stock's current valuation, it's easier to understand why many investors consider Meta one of the most attractive oversold growth stocks available today. The business remains dominant, revenue growth is accelerating, artificial intelligence appears to be producing tangible results, and the stock trades at a valuation that many would consider surprisingly reasonable. That's a combination worth paying attention to. So when I look at Meta today, I don't see a mature company running out of opportunities. I see a dominant platform entering its next phase of growth. And if artificial intelligence delivers even a fraction of what management expects, today's valuation may eventually look very attractive in hindsight. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd love to hear from you. Which company do you believe has the stronger long-term competitive advantage? Lemonade's AI-driven disruption of the insurance industry, or Meta's ability to monetize a network of more than 3.5 billion daily users through artificial intelligence? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.